Okay, so we started this fintech discussion talking about the integration of back office and front office. We moved on to being able to provide a view across all different kinds of products, how the instrument ledger can integrate across the fintech companies and provide a view of that data. We then moved on to personal financial management, business financial management, and being able to use the machines to help us understand our data, our financial world, much more accurately because it gives us a holistic picture across all of the different opportunities. The last thing that we talked about was the community involved and how the community expands to include different products and services based upon an individual's need and our ability to move beyond fractured banking to community banking in a true sense of community financial management. The last thing I want to talk about just briefly is something that kind of started the fintech evolution. At the bottom of Bitcoin was something called blockchain. Blockchain also is called a distributed ledger. Something that's distributed in that it sits on the internet, and anyone that wants to engage in a transaction can use the distributed ledger to form a transaction with another party, independent if they've ever had any sort of relationship with them prior to that time. The distributed ledger stores the transactions and balances in such a way that they can't be modified later, and also stores the smart contracts, something that describes those customer contracts, much like what we talked about with the instrument ledger. One of the key ideas behind the blockchain is it eliminates the need for reconciliation. Because these things are stored and shared, there's no need to have duplicate stores. There's no need for a settlement process whereby two different banks add up the transactions, make sure that the balances that they have are right before they actually exchange money. The distributed ledger does away with that. Many of the same objectives we've talked about with the instrument ledger, with business event processing, with this idea of storing detailed transactions and balances, all can be facilitated through a distributed ledger. But the distributed ledger today, as people are working on this, there's very little work, I think, going on around the analytical side of that, the use of that data. That's what the key aspect of needing balances are. And all of the different uses of balance, all the different combinations that come from those balances, all of the insight that will come from understanding transaction details will require very high speed. It will require tremendous computing capacity in order for us to understand if we're going to achieve the objectives of blockchain and not have to store duplicate balances. If we don't have that kind of speed, a blockchain will end up with multiple data supply chains with balances stored all over the place because our machines won't run fast enough in order to produce those balances in a timely manner. And those balances are what we need to understand the impact of our quantitative world. This idea that we're talking about means compute capacity, the speed of machines, is at the key to this evolution, this revolution that could happen within financial services. But to get there, we have to understand the principles involved in business event processing and balance creation and the core of financial management as it's existed for centuries. That's where the revolution will come, is by understanding that history.